All right, our next reading, measuring and managing market risk. And this is a fairly straightforward one, a little detailed in some places, but let me just point something out here. Our keywords primarily, other than one, our keywords primarily are describe, compare, explain. So we're going to really stick with that. There's only two that we have to go a little bit further on. And it's to estimate and interpret VaR under certain conditions. And we'll see that we really don't have to do much there. So let's go. Let's look at this LOSA here. Explain the use of value at risk in measuring portfolio risk. So let's make sure we know what VaR is first. It is, and I've highlighted three important things of this definition you should pay attention to. It is the minimum loss that would be expected a certain percentage of the time over a certain time period given the assumed market conditions, and we'll talk about or we'll demonstrate a little later on what these assumed market conditions are. So for this minimum loss, it can be expressed either in currency units as a dollar amount or in percentage terms. So let's have a look at an example, and we'll see all three of these conditions in play here. The 5% VaR of a portfolio is 2.2 million over a one-day period. What does this mean? It means that there is a minimum, a 5% probability that in a given day we would experience a minimum loss of $2.2 million. That's over a one-day period. Stated another way, I have it down here, a loss of at least 2.2 million is expected to occur once every 20 days. That's 5% of the time, right? So if we want to, instead of expressing it in currency, if we want to express it in percentage terms, let's say that our portfolio value is 400 million, 5% VaR is 2.2 million. Well, 2.2 of the 400 million is 0.55% of portfolio value. To sort of conceptualize it in normal probability terms, if this is our expected return on a daily basis, and if we're looking at, and this is stated daily, a one-day period, we would have a daily standard deviation as well. Well, if the 5% minimum threshold here is 1.65 standard deviations away from the mean, that would give us the value here, and then of course 5% is everything under here. Notice that the if we're talking about a loss, the loss gets bigger into the tail, right? That's why we say it's a minimum loss that would occur. VaR at 1%, if we wanted a 1% VaR, that would be 2.33 standard deviations away. If we're stating VaR at 1 standard deviation, that's the same as saying a 16% VaR, because, as we know, that 1% standard deviation on either side encompasses 68% of the observations in the normal probability distribution, with 32% in the tail, so there'd be 16 here, and, of course, 16 there, right? The time period, we stated here one-day period. It could be a one-week period, 1 month, quarterly, could be annually if you have the historical data to support that, to support any of these. All right, throughout at least the first part, through value at risk, I'm going to go through the questions in the reading, the multiple choice questions as we get to them, but I'm only going to do it for VaR just to make sure we know what we're talking about here. Number one, given a VaR of $12.5 million at 5% for 1 month. Notice now this is 1 month, right? Which of the following statements is correct? So we should know what this means. We should know how to read that, right? A, there is a 5% chance of losing $12.5 million over 1 month. B, there is a 95% chance that the expected loss over the next month is less than $12.5 million. And C, the minimum loss that would be expected to occur over 1 month, 5% of the time, is 12.5 million. Well, this is the only one that states it in terms of the minimum loss. 12.5 million. How we would read this is there is a 5% chance that we would experience a minimum loss of $12.5 million over a 1 month period. And that's exactly what C is saying. There's your answer. Which of the following statements is not correct? We're looking for a false statement. A 1% VaR implies a downward move of 1%. No, that's not what that is saying. A 1% VaR implies a downward move of 2.33 standard deviations. by the way. It doesn't mean 1%, 2.33 standard deviation. So right away we know that that is not correct. We can select A, but let's just make sure B and C are correct. A 1 standard deviation downward move is equivalent to a 16% VaR. Yes, we've already mentioned that on the first screen. A 5% VaR implies a move of 1.65 standard deviations less than the expected value. Yes, there we go. All right, we're going to do B and C at the same time here. Keywords: compare, estimate, interpret. Heavy on the interpret. And of course, compare is there. Estimate, not too much. Only because we're going to use some really simplified examples. And if you are giving questions on VaR and asked to calculate anything, it will be most of the numbers will simply just be given to you, because there's no way that you can actually calculate it unless you're actually given the numbers. You wouldn't start from scratch. So let's have a look at estimating VaR. There are 3 methods to estimate VaR. I've got them down here in red: parametric method, historical simulation, and Monte Carlo simulation. We'll get to that shortly. But first, number 1, convert the set of holdings in the portfolio into a set of exposures to risk factors. Well, that's what we did in the last reading with multi-factor models, is we determined what risk exposures we had in our portfolio. We could pick whatever multi-factor model we want, say, well, we have a number of different risk exposures. So that's the first thing we do, is a risk decomposition. Because if we're looking at for value at risk, we need a risk decomposition. It makes sense, right? Number 2, gather a data history for each of the risk factors in the VaR model, and we'll see that depending on which of these 3 methods we use, that'll be done slightly differently, especially for the first 2. The third one, not so much. And when I say not so much done differently, not so much done, the gathering of the data history. And then, of course, you just estimate VaR by whichever method that you're using. So throughout, let's use a really simplified example. We'll use a 2-asset portfolio. The portfolio value will be $150 million. And we're going to use 2 ETFs, SPY and LWC. SPY is an ETF that tracks the S&P 500. And LWC is an ETF that tracks the long-term corporate bond, a sector of the long-term corporate bond market. Well, these themselves are risk factors, right? So you have a fixed income a risk factor. You have your market risk factor, because it is the market. This is just selected in such a way that the assets themselves are the risk factors. It assumes the 2 securities are the risk factors themselves. And our portfolio will be weighted 80% towards equities and 20% towards bonds. I'll use the notation, subnotation, S and L to mean SPY and L to mean LWC. All right, well, we've done step 1, which is to convert our holdings into a set of risk factors. And we saw that, well, just by the way that we selected the portfolio, the securities are the risk factors. The second one was to get a history on the risk factors, a price history or a return history on those factors. So we'll get a return history on each ETF, so we need a particular period of time. That period of time we call the look-back period. For here, we'll use July 2012 to June 2014. That's the look-back period. And we can compute the daily average return and standard deviation, then we can annualize it. So for SPY and LWC, this is the actual results over this period of time annualized. Now notice over here we do a subjective adjustment to both ETFs. We've seen this before when we come up with some numbers based on history, and then we ask ourselves, is that representative going forward? Judgment suggests these may not be representative going forward. The long-term expected return on the S&P 500 is 10.5% with a standard deviation of 20. Look at over this look-back period. You got 20% return, almost double, with half the volatility, 11.14. So if we use this going forward, because it has very low volatility, it would underestimate value at risk. And because we're starting with such a high expected return, we'd have to go very far into the tail with low volatility to realize any losses, so that our 5% or 1% value at risk would show that, wow, it's not that bad. We would be understating the risk. So we're going to say, well, let's go back to the 20. We look at the bond ETF, we see that the return is 4.21 versus more of a long-term average of 6%. So that's understating the return, but the risk is pretty much the same. But since we're starting from a lower return, it wouldn't take much of a move into the left tail to start going zero and then negative. So it may overstate the value at risk. So we're going to use long-term numbers on that. So the question is, well, why bother doing a look-back period? Why not just take the long-term for every risk exposure we have? Why not just take the long-term expected return and standard deviation rather than using the real numbers from the look-back period? If they deviate from the long-term and we're just going to subjectively change into the long-term, why waste our time? Why not just look at published numbers for long-term returns on risk factors and use that? Yeah, you could. You could, unless you feel that for some reason going forward will not look like that long-term period. Remember, that long-term period, this smooths everything out. You may believe that there's going to be a deviation from that. Here is a clear deviation from that, but you think, well, because we had the deviation and because of mean revision, we should get back to this. Well, okay. But you can justify whatever you want if you have a firm basis for supporting it, sure. So let's look at this parametric method. Again, begins with risk decomposition of the portfolio holdings. We did that. We saw that we chose them in such a way that it would be easy. The parametric method assumes the return distributions for the risk factors are normal. It assumes that they are normal, otherwise we wouldn't be using things like expected return and standard deviation, right? So for each risk exposure that we have, for each risk factor, we need an expected return and a standard deviation. So to get the expected return on our portfolio, all we have to do is we have the expected return for SPY, we have the expected return for LWC, each of our risk factors, and we know the weightings for each of our risk factors. So to get the expected return on the portfolio, we remember this from level 1, right? It's just a weighted average of each of the respective returns, 0.096. And the standard deviation of the portfolio, we have the standard deviation of each of the risk factors, and we have the correlation between the two. I didn't mention it on the last screen, but I did write it down that the correlation between the two was negative 0.2. So there it is right there, negative 0.2. And if you put in the numbers and you solve, we'll get 0.157483. So now we have the expected return on the portfolio and the standard deviation of the portfolio. We arrived at that by first getting the standard deviation and the expected return of each of the risk factors and then determining what our weights were for the portfolio and building up from there. The return on the equity risk factor and on the bond risk factor, you recall, was 10.5%, 6.6%. Those are annual returns. So this 0.096 is an expected annual return. The inputs are based on annual returns. But if we want to measure VaR on a daily basis, you have to convert these annual returns into daily conversions here. So the expected return on the portfolio is 9.6 per year. Well, of their 250 trading days in the year, just divided by 250, that's the daily expected return. And the standard deviation on the portfolio is the annual standard deviation divided by the root of 250. We get 0.009960. Once we're there, getting VaR is really easy to do. What we want, if we want the 5% VaR, we're over here. That is 1.65 standard deviations away from the mean. What's the mean? 0.000384 minus 1.65 times the standard deviation, and that'll give us a value here. And then if we multiply it by the value of the portfolio, we should have our value at risk, right? So it's the expected return on the portfolio, the mean, minus 1.65 times the standard deviation to get 5%. If we wanted 1%, that would be 2.33. Then we multiply that by negative 1. What's that negative 1 business? Well, VaR, value at risk, is normally stated as a positive number. So to make the math work out, rather than remembering to take the negative and just say it in a positive with a positive number in front of it, we just stick a negative 1 in there because whatever, since we're way in this tail over here, whatever's in the brackets here will be a negative number. So we multiplied this term by -1 to turn it positive, so this will be positive in here. Multiply by 150 million, we get 2,407,500. That's the minimum loss that could be expected at a 5% probability for one day. So for today, if this was the number in the morning, we got a 5% chance of seeing a minimum loss of 2.4 million. If you show up every day with that 5% chance, on average, once every 20 days, you would lose a minimum of that amount. Now, it says a minimum. It says nothing about how much more it would be, but at least you'll lose at least that much in a given day. So earlier, we said the parametric method generally assumes the distribution of returns on the risk factors is normal, generally. That's not an absolute requirement. It typically is this way. It typically is that assumption. It's not an absolute requirement. You can have a different distribution. It just makes your work harder. That's all. We don't have to get into how much, what it does. That's not really required here. Our keywords here, remember, compare, estimate, interpret. Estimate, we're going to do it on a very naive estimation basis, really. And the big thing is to interpret what it means, right? The benefits, simple and straightforward. We've dealt with normal distributions before. Moving away from the mean on any normal distribution, we know is a certain number of standard deviations gets us to a certain percentage in the tails. That's easy to understand. The downside, the VaR is very sensitive to our estimates of expected return and standard deviation. And it's difficult to use if the portfolio contains options, because options have a nonlinear payoff, and that threatens normality. Let's go from parametric to historical simulation. So this is what we did in the parametric method, is we took each risk factor and we took the 2-year history, and we looked at the daily returns over the 2-year history for both of them. We calculated an expected return for this plus a standard deviation, and an expected return for that ETF plus a standard deviation. Rather than do this, we're going to do it a different way. We did this, and then we calculated the weighted average expected return on the portfolio and standard deviation. Well, instead of doing that, what we're going to do is we're going to go back over that 2 years, and we're going to weight the portfolio every day for those 2 years and look at the portfolio return over those 2 years. And then we're not going to calculate expected return or standard deviation. If this is daily returns over 2 years, we'll end up with 500 observations. We'll rank them from the biggest loss to the biggest gain. And then we just use percentiles. So you want the 5% VaR. If there are 500 observations here, there are 25. We count down 1, 2, 3, 4, 5, all the way to 25. There we go. Take the 25th observation. There's your 5% VaR. You want 1% VaR on 500 observations. 1, 2, 3, 4, 5. What's the 5th entry? There's your 1% VaR. That's it. Now on the last screen I said, that's it, as if it were really just that simple. The complexity of the historical simulation method is you have some holdings in your portfolio today. You want to simulate what your portfolio would have done today, as of the holdings today, as if you had held those same holdings over the last 2 years. Well, what if you're holding a bond, a 10-year bond, that has 9.5 years left on it in your portfolio today? Didn't exist 2 years ago. So what do? What if you're holding some equities that recently just had their IPO and they didn't exist 2 years ago? What do? There's where it gets a little bit tricky. There's where there's a lot of modifications to do. You have to use close enough proxies to certain things. You have to make a whole bunch of adjustments, which we don't have to get into. We don't have to understand that. We just have to understand the big difference between parametric and historical simulation is the parametric uses the price history of the risk factors themselves and builds up to a portfolio expected return, whereas historical simulation calculates a portfolio return every day and uses that series instead. And that's as far as this learning objective goes. So let's do a comparison of historical simulation and parametric at 1%, 5%, 16. Here's the numbers we're given. We calculated the 5% for the parametric. If we had worked our way through historical simulation and actually did it, we would have gotten to 1.2 million instead of 2.4 million. So what gives? Why is it off by so much? Well, you remember for the parametric, the expected return that we actually got was like 21% with 11% standard deviation, and we changed it to 10.5 and 20. So we increased the observed standard deviation, the observed volatility, and decreased the return. Well, when you increase the volatility, it's going to increase value at risk. Historical simulation just used the prices for the risk factors each day to calculate the expected return on the portfolio each day, or not the expected return, but the actual day-over-day return on the portfolio. So we use the actual data without modifying anything because we don't have to calculate expected return or standard deviation. So the historical simulation method uses the actual numbers as they happen and makes no adjustment to them. Whereas the parametric method, we made an adjustment. We actually raised the volatility. So this represents the lower volatility that happened over that 2-year period. This represents what we think should be a higher level of volatility. Historical simulation method is not constrained by an assumption of normality because we don't even calculate expected return and standard deviation. We don't care. We just look at the price, figure out what the weighting in the portfolio is, calculate the return on the portfolio. We estimate VaR based on what actually happened. Therefore, it can handle any kind of financial instrument, even options, but no guarantee that this will actually repeat again, right? In the parametric method, we actually made an adjustment because we said, look, this period of low volatility, maybe that's not going to happen going forward, right? Let's change it to its long-term norm. Let's look at Monte Carlo simulation. Kind of like historical simulation in that we're going to rank our output from the biggest loss to the biggest gain and just find the right percentile and just count down, and that's our value at risk. But Monte Carlo simulation doesn't rely on any historical numbers. All it relies on is a description of the return distributions. And it is not constrained by any distribution. We can tell it anything we want. It avoids the complexity of the parametric method when the portfolio has many risk factors. The portfolio we did had 2 risk factors, and each of the securities we held were complete risk factors. That may not be true in a real portfolio. You may have half a dozen risk factors. You may have equities, you may have commodities, you may have foreign exchange, you have country risk. You can have a whole bunch of different risk exposures. So again, you'll set up you'll code all of your inputs and tell the simulator, well, the return distributions look like this, the other ones look like this. There's a correlation between the two that look like these things. Off we go, and it runs a simulation. And you rank your output, and then you just, like we did with historical simulation, if we want the 5%, and if there's 10,000 observations here, we want 5%, we count down 500. Whatever entry is in the 500 slot, there's our 5% VAR. All right, let's do a couple of questions here. Number 1, the parameters of the normal distribution required to estimate parametric VAR are expected value and standard deviation, skewness and kurtosis, standard deviation, and skewness. That was easy enough, I think. Expected value, standard deviation. We didn't even mention skewness or kurtosis, so we could just get rid of those. Number 2, assuming a daily expected return of 0.0384% and a daily standard deviation of 0.9960%, as in the example, which of the following is closest to the 1% VaR? So we calculated a 5. This wants a 1% VaR for a $150 million portfolio. Express your answer in dollars. Well, we knew the 5% was 2.4 million. So 1% cannot be 2.4 million. We're going from 5 to 1, so the loss can only get bigger. This is 1.4, so it must be 3.4. But let's assume that we didn't know what the 5% loss was. How would we calculate this, right? Well, it's the expected return on the portfolio, 0.000384. I'm putting it in decimal form because that's percent. You got to add the 2 zeros, right? Minus, we want 1%, so it's 2.33 standard deviations away, and our standard deviation is 0.009960. Let's multiply by -1 to turn it positive, and multiply all that by the value of the portfolio. and we will get 3.42 and change million. We don't have to go much further than that because 3.4 million jumps out at us. Number 3, assuming a daily expected return of 0.0384% and the daily standard deviation of 0.9960 as in the example, the daily 5% parametric VaR is 2.47 million. Yes, that's just a statement of what we've already done and what we already know. Rounding the VaR to 2.4 million, which of the following values is closest to the annual 5% parametric VaR? Express your answer in dollars. What's going to throw you off is this statement here, rounding the VaR to 2.4. That's almost implying, it's kind of leading you in to thinking that, well, I got to use the 2.4, right? No. We just solve it the way we normally solve it. It's asking what is the annual 5% parametric VaR. So we need just annual numbers. Instead of daily return and daily standard deviation, we need annual. We know that this on an annual basis was 0.096. And we know that this was, let me see, 0.1574. But let's say that we didn't know what they were. Could we get to those numbers? We certainly could. 0.096, sorry, not 0.096, 0.000384, that's the daily number, right, was equal to the annual number divided by 250. So all we have to do is cross multiply, solve for x. We'll find that x is 0.096. And we can do the same thing with the daily standard deviation. We know that 0.00996, I'm not going to put the 0 in, was equal to the annual standard deviation over the root of 250. So all we have to do is cross multiply for that, and you'll find that x is equal to 0.157483. And then we just solve for it the same way we solved for the daily, is you just take the expected return on the portfolio. There's the expected return, minus, what do we want? 5%, that's 1.65 standard deviations away, 0.157483. And we'll multiply that by -1 to change the sign by 150 million. And you'll get 24.57 million. And saying, what is it closest to? Well, it can't be 38 or 6. There we go, right there. 25 million. Okay, a couple more questions. Which of the following statements about the historical simulation method of estimating VaR is most correct? A 5% historical simulation VaR is the value that is 5% to the left of the expected value. 5% to the left, does that make sense? Historical simulation? No, we can get rid of that. That's totally wrong. A 5% historical simulation VaR is the value that is 1.65 standard deviations to the left of the expected value. Well, most of that, it would be correct if we were talking about parametric, a 5% parametric VaR. This is historical simulation. It has nothing to do with the distribution. Remember, we rank them from the lowest to the highest return, and we just we count down and take whatever's in that slot. So that's wrong. We got to choose C, but let's just make sure. A 5% historical simulation VaR is the 5th percentile, 1, 2, 3, 4, 5th percentile, meaning the point on the distribution beyond which 5% of the outcomes result in larger losses. Yeah, exactly. C. Which of the following is a limitation of the historical simulation method? The past may not repeat itself? Yeah. A reliance on the normal distribution? No, it assumes no distribution. Estimates of the mean and variance could be biased. We don't take any estimate of the mean and variance. The past may not repeat itself. Number 3. When will the Monte Carlo method of estimating VaR produce virtually the same results as the parametric method? Well, let's think about that for a minute. In the parametric method, we assumed normality, we assumed an expected return and a standard deviation, and to describe a normal distribution, all we need are those two things. So if we entered in the same expected return and the same standard deviation into the Monte Carlo simulation, we should get the same result. Let's find out if there's a statement that says that. A, when the Monte Carlo method assumes a non-normal distribution. No. B, when the Monte Carlo method uses the historical return and distribution parameters. Or C, when the parameters and the distribution used in the parametric method are the same as those used in the Monte Carlo method, and the Monte Carlo method uses a sufficiently large sample. There you go, right there. 4, which of the following is an advantage of... I should say something about B. I know I didn't eliminate B on the wording. Why is B not the answer here? Well, it's saying when the Monte Carlo method uses the historical return and distribution parameters. Well, the parametric didn't do that. The parametric subjectively modified it. If we want Monte Carlo and the parametric to output the same thing, the Monte Carlo must use what parametric used. Now, if parametric used the historical return and distribution parameters, well, then that's fine. Then they'll do the same thing. But on the condition that they give the same is if the Monte Carlo uses the same inputs as the parametric method. By saying it uses the same historical return and distribution is not the same thing as saying it uses the same as the parametric method. Number 4, which of the following is an advantage of the Monte Carlo method? The VaR is easy to calculate with a simple formula. It is flexible enough to accommodate many types of distributions. Yeah. The number of necessary simulations is determined by the parameters. That's saying which is an advantage. Well, the only one really worded as an advantage here, flexible enough to accommodate many types of distributions. Okay, LOSD, keyword describe. Describe advantages and limitations of VaR, regardless of the method we use to get to it, but just the general concept of VaR. Advantages, it's a simple concept. It's an easily communicated concept. Provides a basis for risk comparison across asset classes and across portfolios. Facilitates capital allocation decisions. We don't like the VaR? Well, then redistribute your holdings. Maybe lower your equity exposure, raise your bond exposure, whatever the case is, but it facilitates those decisions. Can be used for performance evaluation. VaR can serve as the basis for risk adjustments to performance. So when we talk about risk-adjusted performance, you can adjust it based on the VaR that the portfolio manager assumed on a daily basis. Reliability can be verified. You can backtest. So you can come up with an expected return and a standard deviation on the portfolio, and then backtest it on that portfolio, on the returns on that portfolio, to see if you're calculating a 5% VaR, to see if actually 5% of the time the portfolio did have that minimum loss. Widely accepted by regulators. Limitations, subjectivity. The VaR cutoff, 5%, 1%, 16%. The time period, whether you're using 1 day, 1 week, 1 month, 1 year. The estimation method. We saw in parametric method that we subjectively modified the historical return and standard deviation numbers that we got to match something that we thought would make sense going forward. Underestimating the frequency of extreme events, and this is a direct result of the over-reliance on the normal distribution, and a lot of work in finance has been done that shows that left tail events happen far more often than the normal distribution would say so. So if that's the case, and VaR is a left tail measure, and those events happen more often, well, aren't we really just underestimating what's really going to happen by relying too much on it? Continuing on with our limitations, a failure to take into account liquidity. So we may get to a number that says, well, 5% of the time there'd be a minimum loss of 3 million, let's say. But let's just say that under those conditions, when you hit that $3 million mark, and you say, well, maybe we should lower our exposure to risk this day, you might find that, hang on, there's a cost to getting out of things. Well, VaR doesn't reflect that issue. Sensitivity to correlation risk. We left the correlation in the VaR VaR Pro to get to when we calculated the variance on the portfolio. We used a particular correlation measure, but in times of market stress, those correlations increase, which means that minimum loss really is a minimum. The loss could be so much greater than that. In times of market stress, correlations among all assets tend to rise. Vulnerability to trending or volatility regimes. A A portfolio may remain under its VaR limit every day, but just under it. So let's say that you have a $2.5 million 5% VaR per day, and every day you lose 2.4 million. Well, it never triggers that VaR, that threshold. You've never once exceeded it, so you think, well, we're well within our parameters. We've never exceeded it. But you're so close to it every single day, 2.4, so it adds up, right? Those losses would accumulate. Misunderstanding of the meaning of VaR. That's why we took some time at the beginning to explain it is a minimum loss. That does not mean it's the loss you can expect. It's a minimum you can expect. Oversimplification and disregard of right tail events. Right tail events now, you're thinking, well, who cares about right tail events, right? This is what we want. We want those right tail events. But this is it's a limitation. VaR only pays attention to this. It does not pay attention to what your opportunities could be. So if you focus too much on your VaR, let's say that you have a 5% VaR of 3 million, or let's even go to a 1% VaR on 3 million on a daily basis. That means once out of every 100 days you might lose $3 million. That's the distribution. But you have a distribution such that your right tail events are significantly higher. So that this 3 million seen in context of, well, but we make so much, that doesn't really account for very much of what we could make. If you start managing this, you might actually pull in this right tail as well. All right, our next LOSE, keyword describe extensions of VaR. First one, conditional VaR, CVaR. And it's not really a value at risk measure. It relies on a particular value at risk measure. Then it says, okay, that's the condition. So what I'm going to do is I'm going to take every loss that could be greater than that, and I'm going to find the average of it. So it's just the average loss. Conditional on VaR being greater than the cutoff. And how do we get this average loss? Well, typically by back testing. So we'll back test it for 2 years, and we'll look at every instance where VaR was greater than the cutoff. And add them all up and take an average, and that'll be the average loss. Because remember, VaR is a minimum. So if that's the minimum, well, what's the average loss that could happen? VaR, again, minimum loss at a certain confidence. Average loss is how much can I expect to lose if VaR is exceeded, which is why it's called conditional VaR. Also known as expected tail loss or expected shortfall. Incremental VaR, IVaR. How VaR will change if a position size is changed relative to the remaining position. So let's take an example. Here's what we had. SPY and LWC weighted 80 and 20. We found the 5% VaR at 2.4 million. But what if we wanted to weight SPY at 90%? What would be the incremental VaR? So all we do is we say, well, let's recalculate everything with a 90% weighting and 10% on LWC. Calculate the 5% VaR with this, we get to 2.73 million. So incremental VaR is just the difference between the two, is 326,000. So if we just wanted to change our weighting from 80 to 90, the incremental VaR of that would be 326. And that would make sense because we're increasing our exposure to the riskier asset. Next is marginal VaR, kind of like incremental VaR. But we can think of marginal VaR as how value at risk changes for a 1 unit change in something. Conceptually similar to IVaR, but reflects the effect of a very small change in the position. So we might have a bunch of risk profiles, and we might say, well, what's the marginal VaR of each of them? So if this risk exposure changed by 1 unit, however you want to manage 1 unit, whether it be $1, whether it be 1%, whether it be you measure units in $1,000, however it is, but a 1 unit change in each of them without determining what the new position size would be. It's just an incremental, just a marginal VaR. And relative VaR, or what's called ex ante tracking error, the degree to which the performance of a given portfolio might deviate from its benchmarks. So what we do is we look at our portfolio holdings, and from our portfolio holdings, well, actually, let me describe it better than that, is you would imagine a portfolio that would hold all of your holdings and then you take the benchmark, and this imagined portfolio would take all the benchmark holdings as short positions in the same portfolio. So in your portfolio, let's say that you were long 1,000 shares of SPY, but the benchmark was only long 900 shares of SPY. The imagined portfolio would be long 100 shares of SPY because all of the benchmark holdings would enter as a short position into the portfolio. So what's left? What's this 100 SPY? This is called an active position because it's a deviation from the benchmark. So relative VaR really is just, you can think of it more as an active VaR. Right, with VaR wrapped up, let's move on to the next learning objective. And we're going to do 4 at the same time, LOS, F, G, H, I. And that sounds like a lot, but you know what? They're also small on their own. And it wouldn't flow well if I started to break them up. It flows as a nice story, 6 screens long, like we go through 6 screens to get through 4 learning objectives, so that's fairly quick, right? Our keywords here really describe, demonstrate. And we're looking at sensitivity and scenario measures. And in sensitivity and scenario measures, we're going to look at equity, fixed income, and options exposures in each of them. So let's, rather than read all the LOSs, let's just get this idea that we're moving on to something beyond VaR and looking at sensitivity scenario measures. So let's look at sensitivity risk measures and what they are. Examines how performance responds to a single change in an underlying risk factor. So equity exposure measures, the big one here we know is beta. Beta tells us how sensitive the return on the portfolio is to that particular risk factor. We've already covered the idea of factor sensitivity, so CAPM gives us our beta and gives us our sensitivity to that particular factor. You can use a multi-factor model, and I just redrew it out here or reprinted it out to show that you can have multiple factors as well. And each of these factor sensitivities, each of these betas is a sensitivity risk measure. Factor sensitivity, sensitivity risk measure. There we go. Good thing we did the last reading, right? For fixed income, what exposure measures do we have there? The big ones are duration and convexity. So this is the change in the bond price over the original bond price. That's a percentage change in bond price is approximately equal to a measure of duration plus convexity. We saw that in fixed income. Option risk measures. What are sensitivity measures for option? Well, we've been through this before as well. Delta, the change in the value of the option with respect to the change in the value of the underlying. We also looked at gamma and vega in another part of the curriculum. Well, we did all this in derivatives for options. Gamma is the change in delta as the underlying changes. Vega is the change in the option value as volatility of the underlying changes. We have seen all of these sensitivity measures before. Equity sensitivity, fixed income sensitivity, derivative sensitivity, shouldn't say derivative, option sensitivity. All we're doing in this reading is saying, hey, don't forget about those. I mean, let's not just ignore them. Sure, you know about them, but it's not a silo anymore. Everything's integrated. Let's remember that. We also have scenario risk measures. This estimates the portfolio return that would result from a hypothetical change in markets or a repeat of an historical event. So you can go back to the market crash of '87, the currency crisis of the late 90s, the long-term capital management crisis of the 90s, the dot-com crash, the credit crisis, and run your portfolio through those events. It incorporates multiple factor movements. The problem with these sensitivity risk measures is gamma is at a point in time. Vega is at a point in time. Duration is at a point in time. And it just tells us the sensitivity for that particular thing. Well, what if everything's all moving at the same time, right? You can't just look at gamma in isolation. What if everything were moving? Well, that's what a scenario would do. It incorporates multiple factor movements versus single factor movements that we get in sensitivity measures, and it'll use larger factor size movements. Okay, let's dig into the historical scenario method first here. The first thing we have to do is have a look at our portfolio and reprice all our holdings. We can't just run it through a point in time in history with our current pricing. So let's break it down. Equities. Let's say we have some equities. Well, they can be modeled using the price histories as proxies for their expected behavior. What does this mean? Well, let's say that, let me draw a timeline here so we have an idea of what we're talking about. And let's say the period of time we're looking for is this period of time right in here in our timeline, and we're way over here. And let's say that back at this point in time, at the beginning of this period, the stock we're holding was $20 and it ended at $15 at the end of that period. But now it's $45. Well, you wouldn't use $45 at this point in time, but it's clearly not a $20 stock. That's not what we're interested in. What we want to capture is the behavior of the stock over this period of time. We wouldn't expect that it would drop from 45 to 40. We wouldn't expect the same $5 drop, or as a percentage, 25%, it may not do the same thing. It's how it behaved, and we assume that the price movement during that period of time would, if we call that its behavior, would behave the same way. So we will reprice the equities as they existed at that point in time. What if we're holding equities that didn't exist at that time? Well, then we have to find some very close proxies to a stock back then that looked like ours. So we might use a fundamental multi-factor model to help identify some particular equities that matched very closely what we're holding. What if we're holding a mature stock that was considered a growth stock at that point in time? Now, we certainly wouldn't want to remodel this growth stock as if it were this mature stock as if it were a growth stock. So we would have to find some proxy for that as well. So it's not just as simple as looking back. Fixed income and derivatives, they get a little bit trickier. So let's do that timeline again. And let's say that we have two bonds. Let's say this was the year 2000. Here's the year 2030. Here's the financial crisis. Here's where we are. And let's say we bought two bonds. Let's say we bought a bond in 2000, a 30-year bond. So in the financial crisis, it had 22 years left. It was a 22-year bond. As of now, it's a 13-year bond. And let's say that we also bought a 10-year bond 5 years ago. So in 2012, we bought a 10-year bond, so it has 5 years left. Here's the two problems. For the 10-year bond, it didn't exist during the financial crisis. So how do we model that? It had no price history. The 30-year bond does have price history over that period of time, but it had price history when it was a 22-year bond, not when it was a 13-year bond. So it's going to behave differently as a 22-year bond than it would as a 13-year bond. So you have to take all of your fixed incomes and take the current age of your fixed incomes, go back in time and say, let's reprice them with the current age they are now, but with the inputs that existed at that time. What were interest rates at that time? What were credit spreads at that time? And we'll reprice them based on the inputs to the valuation model that existed here, but using the length of their life at this point in time. So I make the points may not have the relevant price history and must be revalued based on what the inputs to a valuation model were historically. And they're repriced under the conditions that prevailed during the scenario period. So we may be at this point in time in a low interest rate, low volatility environment. But before the credit crisis, you'll recall the Fed had interest rates set, I think, at the short-term rate was 5.25. That seems so far away, doesn't it? When we say 5.25, because it's been going on 9 years now that we've been 0.25, 0.5% around the world, under 1% on interest rates in developed countries. To think back that it wasn't that long ago where interest rates were 5.25 at the short end. 5.25. Well, so you got to reprice all of your bonds using those inputs. The scenario period for historical scenarios is chosen to represent extreme market dislocations, often exhibit abnormally high correlations among asset classes as well. So when we're going back in time and looking at the correlations among the asset classes, they may not be the same as they are today. Okay, just a point on that. On the last screen, I made a point about the correlations being different. I should have been more clear. You don't have to model the correlations. You don't have to input what the correlations were between assets, because you're repricing everything and using either historical prices that existed at that time or using current securities with their current lives and repricing them based on the inputs that existed at that time. The price action on all the securities that you have will capture all the correlations. The point that was being made is that you should expect over that period of time that the correlations will increase over that stress period than what the correlations are today. All right. So what do we do now? Well, the scenario is run as if the whole thing happened instantaneously. So let's say that there was a period of 9 months over which the crisis played out that you were running. You wouldn't run it day by day by day by day and look at the effects and analyze that. You would just say, well, let's go from beginning to end. From the beginning of the period to the end of the period, let's just run it all as one event. So then the scenario is run as if the total price action across the whole scenario period happened instantaneously, because we're looking for what's a worst case scenario. Certainly management can step in and take care of things along the way. You're not going to run 9 months in a crisis and not do any kind of rebalancing or any reallocations. You are, but that's not the point of this. The point is to see, can you survive that event? Can your portfolio survive that event unmanaged? So you're going to look at your total return. How bad did you do? You're going to look at your total return versus your benchmark. Here, hopefully, how well did you do? Hopefully you can survive a crisis better than the benchmark. Also, you're going to see what kind of extra collateral or cash requirements arose as a result of the scenario, especially for leveraged portfolios with derivatives. You could hit margin calls. And margin calls have a way of showing up every few minutes. As soon as you meet one, especially in dropping markets, it's not long before the next one is there. Then the next one, then the next one. You have this cascading need for collateral or cash. And that's what pretty much kills you on the downturn. Is if you weren't leveraged, you could ride it out and everything comes back. It eventually comes back. So if you just ride it out, you could be okay. What kills you is that leverage, because now you have to exit. You either have to hedge out, which means you may miss some of your rebound being hedged, or you have to exit. A modified approach of historical scenario is what's called a staggered scenario, which allows expected management action. So let's say that, again, we had this 9-month scenario where we ran it all at once. Well, you may have 2 quarters. You may say, well, in 1 quarter, what would we do? In the next quarter, what would we do? And you'd look at the output from running it all at one time versus what actions would we take and what would be the result. Would the actions make it worse or would the actions make it better? Here's a thing when you get into crisis sometimes, is what you think will work as a hedging tool sometimes stops working as a hedging tool. So you may think you're hedged, then a crisis hits, and you realize that the 2 legs of your hedge aren't offsetting each other, but are adding to your problem. They're actually making things worse as opposed to making things better. Your position's moving away from you, but your hedge is moving away from you as well. This is not too popular. The idea here, again, is just to see, can a portfolio survive that kind of impact? Hypothetical scenarios, kind of like historical scenarios, but they are imagined. They have never been experienced. The reason you would have something like this is just a bit of logic. Says, look, yeah, you have events in history you could look at, but they don't repeat. You're never going to get the same thing to happen again, and every crisis starts in a different place. To have the same thing happen the same way and unfold the same way, that's pretty much not going to happen. So these hypothetical scenarios allow you to come up with imagined scenarios, but have not yet been experienced. All right, so here's how we would proceed. We would identify the portfolio's most significant exposures, typically the top 10, and then we would apply a reverse stress test to that. So what is this reverse stress test business? Well, if we're going to do a stress test, what we do is we identify an event, and then we apply that event to our portfolio to see what happens to our exposures. In this particular situation, we start, let me just write that exposure in. In this particular situation, reverse stress test, instead of going from the event to the exposure and seeing what happens, we start from the exposure and we imagine an event that would change it. And what we're trying to do is, of the top 10 exposures, we're trying to imagine an event that would stress all of them at the same time. So I draw it out a little better for you here. Stress test, we have an event. We look at the effect on the factor risks, which will then give us an effect on the portfolio. For a reverse stress test, we identify our factor risks. From there, we come up with some imagined events, and then we look at the effect on the portfolio. So these imagined events answer questions like, what would increase the riskiness of the risk factors? All of them. We may also design a rare but not impossible scenario, an earthquake, war, a banking collapse. How would we handle that? The goal is to understand the risks, not to eliminate them. Because if you have a portfolio that has no stresses, that when you run it through an event, nothing stresses, it's likely that it's going to return little more than the risk-free rate. Because you've taken no risk, there'll be no opportunity. So in doing all of these stress tests, you're not looking to say, okay, well, let's get rid of this, let's get rid of that. You're just saying, I just want to understand what's going to happen so that I'm prepared. If leverage is used, you may use a single factor stress test to assess if a given exposure is likely to impair your capital. So what do we mean by that statement? Well, let's take something like banks or very leveraged funds. The big problem that they run into is, what's the point of stressing all of your stress factors when one of them can cause a liquidity event? And if that happens, then it's over. So you take the first one, your biggest exposure, and you'd say, how bad an event would have to occur before we would have trouble either with our capital reserves or with meeting a margin loan with cash that we don't have? Well, let's compare sensitivity and scenario measures to VaR. Value at risk gives us a measure of losses or expected losses in typical conditions on a going forward basis. And the probability of large losses. Sensitivity or scenario measures don't quite do that. They look at changes in the value of an asset in response to changes in something else, changes in the environment. It says nothing about the probability of the change or the probability of the loss. It does inform, however, which VaR does not, it does inform about what is driving the risk. So with VaR, we might have 5% loss of at least 2.2 million on any given day. But we don't know what would drive that to happen. We don't know what event would cause that to happen. Value at risk uses market returns from a look-back period, a representative period. Scenario analysis uses market returns from a specific unrepresentative time period. That's scenario. If we're going into hypothetical measures, well, then there is no a specific time period. It's just an imagined event, right? VaR, sensitivity, scenario analysis, best used in combination. We get an idea of a representative loss from just normal business conditions, and because the representative period clearly won't have anything unrepresentative, we also get measures of, well, what happens if it's not representative? What happens if something big happens? Here's how we stack up against that. And we'll wrap up this topic, the sensitivity scenario measures, with advantages and limitations. So advantages, they do not rely on history. How can we say that? A scenario measure, the historical scenario method does. We take a period in time. So what are we saying here? This is more for the hypothetical scenario that you can imagine something that hasn't happened. You don't have to rely on history. Scenarios can be designed to overcome any assumption of normal distributions. You can use a 1, a 10, or a 1,000 standard deviation movement. Scenarios can cherry pick which exposure gets the worst movements. But historical scenarios are not likely to repeat in exactly the same way. Hypothetical scenarios may incorrectly specify how assets will co-move. Again, hypothetical, right? Because hypothetical, all you're doing is you're imagining something. Hypothetical scenarios can be very difficult to create and maintain because you have to identify, well, how are all the factors going to move and how are all the relationships going to move in this hypothetical scenario, because you have no guide for it. It's hypothetical. And it may be difficult to know how to establish the appropriate limits because, again, it's hypothetical. All right, we're now on LOSJ to explain constraints used in managing market risks, including risk budgeting, position limits, scenario limits, and stop-loss limits, which you see on the screen. The next screen is explain how risk measures may be used in capital allocation decisions. Now, When we're talking about constraints, we're talking about constraints on the measure, so that when we run a certain scenario or look at a certain outcome, like value at risk, we may be uncomfortable with the measure, so that we would then engage in some sort of allocation or reallocation of assets to manage that risk measure, and in managing the risk measure, hopefully manage the risk. So the constraint is the limit that is placed on the risk measurement. If it is too high and too tight or too restrictive, it constrains opportunity. You can control risk and manage risk down to zero, but you also manage that opportunity down to zero, right? If it's too low, well, then you have the potential of suffering outsized losses. So there's some balance between them. That balance relates to the risk appetite of the particular entity in question. So let's look at some constraints placed on risk measurement. Risk budgeting. The total risk appetite is allocated to sub-activities. So let's say you have a VaR limit of $4 million on a daily basis, and you have an entity that is exposed to market risk, to credit risk, and to operational risk. You may budget that $4 million across the three risk profiles as follows. So market risk of $2 million, you have to get your VaR limit down to $2 million, so you'd allocate your portfolio in such a way that would be the VaR measurement. So the limit on the risk measurement, 2 million VAR, then constrains the types of risks you can take on within the portfolio. Same with credit, same with operational. Position limits. This is a control on overconcentration. So you have position limits per issuer, per country, per currency, on gross sizes. Scenario limits, a limit on the estimated loss for a given scenario, so that if you run a particular scenario, you may have a threshold loss that you say, well, if within this scenario the potential loss is greater than this threshold, let's change the allocation of our assets. Let's rebalance this portfolio, run it again until, given this particular scenario that we're running, the loss that would occur is below the threshold. And stop loss limits. When a loss of a particular size occurs in a specified period, you will either reduce or liquidate the portfolio. So you may have a VaR of let's say a value at risk, a daily VaR of 5%, and that might equal $2 million. Or you may have a weekly loss of let's say 7 million. And so on day one, you might run 1.9 million loss. Day two, you might run 1.9 million loss. So you never are triggering VaR, but as soon as you have cumulative loss of 7 million, which if you're just under your VaR, that would be a nice backup to VaR, and that would trigger something to happen, either reduce your positions. You'd look at your factor exposures, you say, well, obviously it's probably the biggest one that's causing grief. Well, it might not be, but you'd start there. Or you'd simply just liquidate. This, by the way, this type of thinking and this type of strategy is a typical strategy followed by proprietary traders and individual professional traders. Is that typically it's set at 5% on the week, 5% of capital, that if you lose 5% of your capital in any 1 week period, you simply flatten all your positions and you go away for a while. Typically for the next week. So if by Wednesday you're down 5% on your capital, you flatten, take Thursday and Friday off, we'll see you on Monday. Because when you're down that much, and you'll learn this in level 3 when you look at behavioral finance, you're more prone to take on riskier positions to get that money back, which will only make things worse. So the best thing to do is just get you away from the trading desk, go away, clear your head, come back when you can think more objectively. So here's an example of what I just talked about. Let's say you have 10-day 5% VaRs, 5 million, stop loss 8 million, cumulative monthly loss. So even though you have a 10-day 5% VaR, 5 million, if you're running losses that are under VaR, even over the course of a month, if you have cumulative losses of 8 million, you'd hit a stop loss. Instead of, I said you could either reduce your positions or liquidate, you may hedge instead after losses of a given magnitude. And this is very common in futures trading, where you would take on a position, and if it works against you, after a certain point, rather than triggering a stop loss, you'd simply hedge it out with maybe an option on the futures. It limits it'll stop the losses and maybe still salvage a small gain out of that position. That's called drawdown control or portfolio insurance. The problem with doing this, it sounds nice, right? Oh, well, you never actually have to take a loss and you might squeeze out a gain. That's true, but it ties up capital in what may be a position that will return only itself. So it might be worth taking the loss and getting into something else, right? Finally, risk measures and capital allocation. Here you'll start with a measurement of economic capital. That's a capital needed to survive a severe loss. And some minimum level will be established. That defines the risk appetite in economic capital terms. That is then subdivided among either your units, portfolios, your asset classes, whatever the case is. In other words, you allocate whatever, because we're talking about capital, right? We're defining your risk appetite in economic capital terms. So you allocate capital such that you will have, in some severe loss, you'll still have this minimum level of capital remaining. Typically used when leverage or meaningful tail risk is present. And meaningful tail risk are things like selling options or large concentration positions. Selling options, remember, that's limited gain, unlimited loss, right? You sell the option, you get the premium. If it works out, you keep the premium. If you're wrong, the losses can continue to add up and add up and add up. But you can always use drawdown control. Even after selling an option, you can hedge yourself out if it looks like it's not going to work out. I'm going to walk towards the real world a little bit here. Describe risk measures used by banks, asset managers, pension funds, and insurers. And this section is detailed. As you read it, every sentence seems like it's introducing some new information that potentially sounds important. But what we want to do is we want to extract the big themes out of it, rather than having to describe every financial entity we get to. Is there some broad characteristics we can use to describe an entity, saying, well, they possess this and this characteristic, so they're most likely to use these type of risk measures, as opposed to looking at every single one and listing what they would use. And there are. We'll do that right away. Then we'll go through each of these entities, and in going through them, like I said, there's a lot of detail, and it seems sort of counter to be able to say that you can extract the essence of the detail. Isn't the essence of the detail itself? Isn't that the point? Shouldn't you be giving me all the detail? Well, to do that, I'd simply just be reading the book to you, sitting by a fireside with a camera and reading to you, dramatically reading it to you, but still reading it to you, right? So you may want to read this section on your own. There is a lot of detail if you're interested in some of these other entities that I'm going to leave out. I'm just looking for the big themes here. So 3 factors influence the type of risk measures that are used. The degree of leverage that is used. Here, you're going to focus more on the assessment of minimum capitalization or maximum leverage ratios. If you have a high degree of leverage, stress tests, potential loss measures over very short periods of time will give you our risk measures you would look at. Number 2, the mix of risk factor exposures. Equity, fixed income, options, you're going to look at what mix you have. If you're really just one, let's say you're a large cap asset manager, long only and semi-active. Well, you only have one risk exposure. It'll focus more on just that one. So the mix of risk factor exposures, well, then that dictates what sort of measures you're going to need, right? And finally, the accounting and regulatory requirements. For instance, fair value versus book value. Mutual funds, held for sale investments, especially on banks, have to be listed at fair value. So for that, you're going to look at measures of value at risk, economic capital, duration, beta, which all rely on changes in fair value. So economic capital we haven't gotten to yet, so I give you a little definition on the side. It's the amount of capital a firm needs to hold if it is to survive severe losses from the risks of its business. And if you rely more on book value accounting and book value presentation, your asset liability gap models, and we'll talk a little bit more about those shortly. All right, let's look at banks and look at some of the measures they would look at. I've written them down in blue: liquidity gaps, value at risk, leverage, sensitivities, economic capital scenario analysis, and I give you some of the narration that comes in the reading. So we'll go over it quickly because it's really just narration. And it's all pretty self-explanatory. Liquidity gap: the extent of any liquidity and asset or liability mismatch. For value at risk, for the held for sale or trading portion of the balance sheet. Leverage: weight assets by risk. The riskier assets are assigned a greater weight, then you divide by equity. So you wouldn't just take your total assets and divide it by equity. You take your total assets weighted by risk, again pointing out that the riskier assets are assigned more weight, so that your numerator can potentially be greater than your total assets, and then you divide by equity. More equity is required to support riskier assets. Sensitivities: this is for the held for sale portion of the balance sheet. And sensitivities would be things like duration, key rate duration, partial duration for any interest rate portion, any forex exposure, commodity exposure, equity exposure. You'd want sensitivities to each of those. Delta, gamma, vega for options. We've talked about sensitivities quite a bit. Economic capital: this is applied to the full balance sheet. It blends market, credit, and operational risks. Total loss at high level of confidence over a 1-year period, let's say like 99.9%. Scenario analysis: stress tests applied to the whole balance sheet. Assess capital sufficiency. So you see banks have quite a few measures that they go through. All right, let's look at asset managers. They're not regulated like banks are in terms of capital reserves or liquidity requirements. Their risk management measures will focus more on volatility, the probability of loss, the probability of underperforming a benchmark. We'll look at two types of asset managers: your traditional long-only asset managers with very little, low or no leverage, and then we'll look at hedge funds. So traditional asset managers, they use little, low, or no leverage. Risk measures would include what we have down here: position limits, sensitivities, beta sensitivity, liquidity, scenario analysis, active share. Let's go through each of them. A position limit: position limits on country, currency, sector, asset class, all measured as a percentage of portfolio value. Do any of your positions exceed these position limits? Sensitivities: we've talked about all the sensitivities before. Beta sensitivity for equity-only accounts. Liquidity: percentage of the average daily volume per security that you hold. Would be a measure of of potential liquidity or the need for liquidity. So if you hold a position that represents 110% of the average daily volume versus another position, let's say in a small cap with very low daily trading volume, where suddenly you own 900% of the average daily volume, well, that one's going to be very difficult to get out of. So you have a potential liquidity problem there. Potential. Scenario analysis, active share. This is the measure of the percentage of the portfolio that differs from the benchmark. What percentage differs from your benchmark? Continuing on with traditional asset managers, redemption risk. This is more for open-ended funds. Ex post versus ex ante tracking error. Ex post tracking error, we know, is the return on the portfolio minus the return on the benchmark, and it's historical. Ex ante tracking error assesses the potential tracking error based on current portfolio versus benchmark, based on wherever the current portfolio is versus what the benchmark is in terms of the holdings. Value at risk, more for absolute return strategies. Hedge funds, well, they use leverage, so let's see what changes here. Sensitivities: gross exposure, leverage, value at risk scenarios. Sensitivities, again, the full range. Gross exposure, what is this? Well, you may have especially for long short funds or market neutral funds, typically they'll have long positions and short positions. So they may be neutral, net short, net long. So you'd look at your long exposure, your short exposure, and your gross exposure. So long exposure is your longs minus shorts. Short exposure is short minus long. If you're balanced, your long exposure would be 0, your short exposure would be 0. And your gross exposure, where you take the absolute value of your longs plus the absolute value of your short exposures, and you look at that's called a gross exposure. So just to give you an example, let's say that you're long $1 million and you're short 500,000. Well, you're net long 500,000. If it were reversed and you had $1 million here and 500 here, you are net short 500. But under both scenarios, your gross position is 1.5 million. You simply add the two together. Why would you do something like this? Well, the idea is in a hedge fund, perhaps your short positions are hedging your long positions, but in times of market stress, sometimes your hedges just stop working and actually work against you. So you'd want to know what your gross position is, because it could potentially all work against you. Leverage doesn't need to be spoken of. We pretty much know what leverage measures are. Value at risk, at high confidence intervals over 90%, and over short time periods and scenarios, specific risk, whatever specific risk you may have. Stress test those specific risks. All right, still on the hedge funds here. Another risk measure is something called drawdown, and this is just a number of what the worst returning month was, or the worst returning quarter, or a worse peak to trough decline. Pension funds, and we're just going to focus on defined benefit pension. Interest rate and curve risk provides the discount rate for arriving at the present value of the liability. So what would make the liability bigger? What would make the pension obligation worse? Interest rates dropping, because if rates are dropping, your discount rate is dropping. If your discount rate is dropping, the present value of those obligations is higher. Suddenly we have a problem. So with rising interest rates, the present value of pension obligations actually gets lower. Surplus at risk. Assets, long positions, liabilities as short fixed income positions, and measure how much assets might underperform the liabilities. So pension funds, as we know, because they're regulated, cannot take short positions. Pension funds are long only funds. They can't use leverage. Well, I shouldn't say they can't use leverage. They're highly regulated on the type of leverage they can use. Typically, they have to hold a position basically paid with cash, so no margin, let's say that. Very limited derivative use and long only positions. So a pension fund's assets are pretty much all in long positions, but you can model the portfolio using the liabilities. Now the liabilities are the future payments they have to make. You can model them as short fixed income positions. And look at the portfolio together and then measure how much assets might underperform the liabilities over the year. If some threshold level is surpassed, changes may be made to asset allocations. This is called liability-driven investing, where you invest to meet these liabilities, that your choices, your asset allocation is driven by meeting these. So if you're going to underperform, if your assets are going to underperform, you're going to have to reallocate some of those assets. So if there are going to be changes in the asset allocation, it may not be the case that it could be done all at one time, because funds take a very long-term view of assets and are not too worried about short-term or day-to-day liquidity. They take a long-term view. So some of the assets they may be in may not lend themselves well to reallocation or rebalancing in the near term. So you have to have a measure of how long it takes to change allocations. That's something called a glide path. Multi-year stages to change a portfolio from a current state to a target state. Liability hedging exposures in your portfolio versus return generating exposures. And obviously a pension fund cannot be 100% in return generating assets. It has to hedge these liabilities. So you'd want to know, well, what balance do we have in our portfolio of hedging liabilities versus generating returns. Let's move on to insurers. Here, insurers face significant regulation and accounting oversight. And the regulation and the accounting deals with how they must retain reserves and reflect their liabilities. And insurers differ based on the type. So we're going to look at property and casualty and look at life. So property and casualty, sensitivities and exposures, economic capital and value at risk, and scenario analysis. And we're looking at value at risk. For insurers, there's really two sides of this that you have to look at. The market risks in the portfolio, because you have money committed to certain assets. What risks do you have there? Also, the characteristics of the insurance exposure. And life insurers. These have stronger ties to financial markets because a lot of this money, especially in life insurance policies, much of it is tied to market performance, especially things like segregated funds, which are life insurance policies tied to some value of a market portfolio. Risk measures here: sensitivities, asset liability matching, scenario analysis. Since we know what all of these are, there's no need to describe in detail. Again, for this section, there's just so much detail that if I started making a note on the screen of all the detail, it would simply be much easier if I just read the chapter to you, read the reading to you. So you can watch the videos, but you really, after watching the videos, you really should do a read of the chapter. You'll find that it reads much easier after you watch the videos because you don't have to stop every so often and go, hang on a second, what are you saying? That you get it. But that you, as you're reading the chapter, you'll pick up on extra detail that I've sort of left out, and when you pick up on it, you'll understand that, oh, well, that's a small little detail that if I started putting it all in the videos would balloon up to be 10, 12 hours for each reading, and, well, what's the point of that? At that point, I'm saving you no time.